Next question. A company earns a profit of rupees 3 lakhs per annum after meeting its interest liability of 1 lakh 20,000 on 12% debentures. The income tax rate is 5050 percentage. The number of equity shares of rupees 10 each are 80,000 and the retained earning amount to rupees 12 lakhs. The company proposes to take an expansion scheme for which a sum of rupees 4 lakhs is required. It is anticipated that after expansion, the company will be able to achieve same return on investment as at present. Funds required for the expansion can be raised either through debt financing at the rate of 12% or by issuing equity shares at par, that is at face value. Compute EPS if additional funds were raised by way of debt financing and if additional funds were raised by issue of equity shares. Advise the company as to which source of finance is preferable, that is a question. I request all of you to go through the question, please. Let us have understanding how to make calculation of the answer for this question. I request all of you to pay attention. First of all, we are trying to understand what kind of information is given to us in this question. Let us visualize this as a balance sheet of the company. The question is providing the information. A company earns a profit of rupees 3 lakhs per annum after meeting its interest liability of 1 lakh 20,000. So that is an interest expense of 1 lakh 20,000, and after meeting with the interest liability, the earning before taxes is given to us an amount of 3 lakhs. Like that information is given to us. Rate of interest is provided as 12%. So just I am doing it like this. We understand that so the interest is equal to PRN upon 100. That is a simple formula. Amount of interest is given as 1 lakh 20,000. What is principal amount, that we do not know. What is the rate of interest? It is 12%. And the time period is 1 year. So the principal amount is 1 lakh 20,000 divided by 12%. That comes to rupees 10 lakhs. This is the way we can have the calculation of the principal amount. So basically we understand that there is debentures that the company has issued. You don't have to write anything. An amount of 10 lakhs. Income tax rate is 50%. Number of equity shares of 10 each are 80,000. So the company has issued equity share capital. 80,000 is the number of shares and face value is 10. That comes to 8 lakhs. Next, they have provided that the retail earning amount to 8 lakhs. So P&L account balance, that is an amount of rupees 12 lakhs. Okay. The company proposes to take, this is an important point, an expansion program. Like that, so the information is given. An expansion scheme for a sum of rupees 4 lakhs. So basically, friends, the question is providing the information that say whatever the funds that we have employed right now, with that say the earning before interest and taxes is 4 lakh 20,000. This is EBIT. And right now we have employed an amount of rupees 30 lakhs in the business. 8 plus 10, 18, 18 plus 12, that comes to 30 lakhs. So right now we have employed an amount of rupees 30 lakhs. And with this amount of the funds, the operating income is 4 lakh 20,000. The question says that say now we are going to expand our business. What is the amount by which we are going to expand our business? We are going to expand by an amount of 4 lakhs, like that information is given. Okay, the question speaks like this further. It is anticipated that, so we are expecting that after the expansion, the company will be able to achieve same return on investment as at present. So whatever the rate at which you are earning right now, what is the rate at which you are earning right now? We can say that, say 4,20,000, 4,20,000 divided by 30 lakhs, that comes to 14 percentage. So this is what, say, you are earning right now on an investment of rupees 30 lakhs, means your rate of earning is what? 14 percentage. So the question says that, say right now you are earning at the rate of 14 percentage, and the same rate you will be able to earn on this 4 lakh rupees, like that information is given. What does it mean? It means that, listen carefully, 4 lakhs into 14 percentage. So this expansion is going to give you, so the additional earning of 56,000, like that information is given. So if at all you are expanding your business, then in that case 4,20,000 plus 56,000, your overall earning will be 4,76,000, like that information is given. So once you will expand your business, you will be having, say, your operating income 4,76,000, like that information is given. I request all of you to write down answer. First of all, let us write this much answer. Step number 1, calculation of existing ROI, return on investment. In the write down, working note number 1, calculation of debentures. So I is PRN upon 100. Amount of interest is 1,20,000. What is principal? We do not know. Rate of interest is 12 percentage. Time period is provided as 1 year. So as far as the principal is concerned, it is 1,20,000 into 100 divided by 12. That comes to rupees 10 lakhs. This is the way the amount of the debentures is calculated. Working note number 2, calculation of present return on investment. In the return formula, EBIT upon capital employed. Into 100, for getting answer in percentage term. EBIT is EBT plus interest divided by EBIT, that is equity share capital plus retained earning plus debentures into 100. Earning before taxes is given to us in the question 3 lakhs. Amount of interest is given 1,20,000 divided by equity share capital In that it is 80,000 into 10, 8 lakhs, plus the amount of the retail earning is given to us as 12 lakhs, plus amount of the debentures is 10 lakhs into 100. So it is 4 lakh 20,000 divided by 8 lakhs, 12 lakhs, 10 lakhs into 100. 4 lakh 20,000 divided by 30 lakhs into 100. It comes to 14%. So we have computed the present return on investment. Step number 2, calculation of EPS for both alternatives. In that I am preparing one working note for all of you. Write down answer along with me. Working note number 1, calculation of number of equity shares to be issued. Because friends, there are two options that we have. One is the debt financing and another is the equity financing. The question says that in case of the equity financing, we are going to issue the equity shares at face value. Like that information is given. So in that case, it is amount divided by issue price. Amount is 4 lakhs. Issue price is rupees 10. So number of equity shares will be 40,000. That is the way the number of shares to be issued will be calculated. Next, calculation of earning per share for each option. There are two options that we have. The first option is debt and another is equity. I request you to put answer in the chat box. What would be the earning per share if at all we expand our business by raising the debt financing? Let us start doing answer. We can start doing answer taking earning before interest and taxes. See, as a student, you can do EBIT answer in two ways. It is existing, that is 4,20,000, which we have found above, plus it is 3 lakhs into 14%. Because 14% of 3 lakhs, that comes to 14% of 4 lakhs, because we are going to expand by 4 lakhs. So 14% of 4 lakhs comes to 56,000. 420 plus 56, that comes to 4,76,000. Or otherwise, we can also understand that the answer can be calculated as the current capital employed is an amount of 30 lakhs. We are going to expand by 4 lakhs. So the total capital employed is 34 lakhs into 14%. So 30 plus 4, 34 into 14%, 4,76,000. less existing interest. We understand that say right now the company is having say the debt financing of an amount of 10 lakhs which we have calculated above, and the rate of interest is 12 percentage. So 1 lakh 20,000. Then I am writing new interest. Language of the question speaks very clearly that say the funds required for expansion can be raised either through debt at the rate of 12 percentage. So what will happen? So this additional financing that we require of rupees 4 lakhs will have interest rate of 14 percentage, 12 percentage. That comes to 48,000. EBIT minus interest is EBT. So it is 4,76,000 minus 1,20,000 minus 48,000. That is 3,08,000. Income tax rate is given as only 50 percentage. Here they have provided. So the tax 50 percentage. That comes to 1,54,000. Earning after taxes is remaining 50 percentage, 154. The same would be divided with the number of equity shares. We understand that say the number of equity shares are 80,000, again given to us in the question. And with that say we can compute the earning per share. So please use your calculator. 1,54,000 divided by 80,000. That comes to 1.925. I request you to write an answer for debt and please calculate answer for the equity and put your answer in the chat box. In case of the equity, amount of the EBIT will remain same. 4,76,000. Existing interest will remain same. 1,20,000. There will not be any new interest. Why? Because we are going to expand our business using equity financing. Earning before taxes will be 476 minus 120, that is 3,56,000. Income tax rate is 50 percentage, that is 178. Earning after taxes 178. There is no preferential capital, so earning after taxes itself is earning available to equity shareholders. 80,000 plus, we have to issue additional shares of 40,000. So what will happen? It is 80 plus 40. Number of equity shares will be 1,20,000. 178 upon 120, that is 1.4833. That is the way earning per share can be calculated. Between these two, a financial plan which is having a kind of option which is having higher earning per share is selected, that is the debt plan. So let us have a summary of the entire answer. Dear students, the question is providing the information that there is an existing company which is going to expand its business. We are required to take a decision over here that how the company will finance the additional funds, either by way of the debt financing or by way of equity financing. That is a question. For this decision making, say what we will do, friends, we will make the calculation in this sequence. First of all, we'll compute that say what is the existing capital employed. The reason behind that is language of the question clearly says that the company wants to I'm sorry, the company is anticipating that whatever the rate at which it is earning right now, that itself is the rate at which it will be able to earn once it is expanding the business. So first of all, we compute so the capital employed, and for that, so the debentures value is calculated. Second is, say the present return on investment is found. It is simple operating income divided by capital employed. Capital employed is consisting of, say the all long-term sources of the finance taken together. Equity, reserves, debentures. So 8 plus 12, 20, 20 plus 10, 30. Operating income is 420, so the return is 14%. Second step is calculation of the EPS for both the alternatives. In that, the first working note is calculation of the number of equity shares to be issued. It is so the amount divided by issue price, that is 40,000 shares. In case of the equity plan, you have to issue the new equity shares. Then EPS calculation for debt plan and for equity. For debt plan, EBIT 476, that is so the existing 420 plus additional 4 lakhs will generate a earning at the rate of 14%. 476 minus interest existing and the new, EBT minus tax is EAT, divide by number of equity shares will give EPS. Similarly for the second one, EBIT is going to remain same, existing interest is going to remain same, new interest will not be there. Why? Because we have issued new equity shares. EBT minus tax is EAT divided by number of equity shares, existing 80,000, new 40,000. Accordingly, the EPS is found 1.4833. Right on, final answer. The company should raise additional financing by way of debt. That is the way we are required to write answer.